If you're over 55 and still paying for life insurance inside your superannuation, there's a good chance you're handing an insurance company $600 every single month for cover you probably don't need anymore, and you might not even notice it happening because it never shows up as a transaction in your everyday bank account. Most of the standard advice out there tells you to set your super and forget about it. That advice was written for someone in their 30s with 40 years to ride out the market. At 60, the default settings inside your fund stop being your friend. They start being a leak, and leaks like that compound quietly for years before anyone goes looking for them. In 2026, ASFA prices a comfortable retirement for a couple at $77,375 a year, and that figure keeps climbing every time it's reviewed. 5 ordinary purchases are quietly eating into that number before most people even notice, and each one looks completely reasonable on its own. We're told to buy a new ute before the end of the financial year to save on tax, or to switch our super into a cheap index fund to save on fees. Both moves sound smart on paper. Both of them can cost you more than they save us, because at 60, a bad year in the market doesn't behave the way it did at 30, when you still had decades to let the numbers recover. I'm going to walk you through the 5 things worth thinking twice about before you buy them. Starting with the fee, most Australians don't even realise is coming straight out of their balance every month. Sometimes, for years after, it stopped making any sense to keep paying it. If you're in that 55 to 65 window, and you're tired of advice built for someone half your age, stick around. This channel only cares about the numbers that matter for the stretch you're actually in. Here's the first one, and it's already sitting inside your account without you lifting a finger. $600 a month. That's the actual premium a lot of Australians over 60 are paying for life and total permanent disability cover, sometimes shortened to TPD, built into their super fund by default the day the account was opened. The reason it costs so much comes down to something called stepped premiums. Every year your insurer recalculates the risk of paying out on your policy, and every year past 55, that risk goes up sharply in the insurer's eyes. So the premium climbs too, usually much faster than most people notice, because it's deducted straight from your super balance before you ever see the number that gets reported to you as your annual return. Nobody sends you a bill. It just quietly disappears from the total. Funds set this cover up as a default because it's cheaper to insure a huge group of people all at once than to assess everyone individually. That works well for someone in their 30s who needs the cover and would otherwise never get around to arranging it. It stops working the day your circumstances change, and nobody goes back to check whether the settings still fit the person you've actually become. I've sat across from people who couldn't tell you what their cover was actually for anymore, let alone whether it still matched their life. This isn't really about being uninsured. It's about protecting the right thing at the right stage. If your house is paid off and your kids have moved out and built their own lives, who exactly is a $500,000 life policy protecting when it costs you close to $7,200 a year just to keep it running in the background? Run the numbers on that $7,200 a year sitting somewhere else instead. If it stayed invested in a balanced fund earning 6% a year, by the time you went from 60 to 65, you'd be looking at roughly $41,300 that never left your account and kept working for you the whole time. That's not pocket money, and it's not something you can make up later by working a bit longer. Services Australia still sets the age pension age at 67, and every dollar you lose now is a dollar you're further away from the lump sum ASFA says a genuinely comfortable retirement needs. It takes one phone call to your fund to find out whether you're even still paying for this, and most people who make that call are surprised by how long it's been running unnoticed. Insurance isn't the only place your balance is quietly bleeding, though. There's a much bigger trap hiding inside the thing almost everyone tells you is the safe option: low-cost index funds. Standard advice says, buy a low-cost index fund and leave it alone. That's genuinely good advice if you're 35, with decades ahead of you and no need to touch the money anytime soon. At 60, it can be the wrong advice entirely, and almost nobody explaining it to you stops to say why. The reason is something called sequence of returns risk. If you move your whole balance into a fund tracking the ASX 200 purely to save 0.5% in fees, and the market drops 15% in the exact year you retire, you're not just down on paper the way a 35-year-old would be. You're forced to sell units at the bottom just to pay for groceries and electricity bills, and a balance that's already shrunk never gets the same chance to recover that it would have had decades earlier. That trade-off stays invisible for years, right up until the 1 year it isn't. An index fund is genuinely excellent while you're still adding money to it every payday. It behaves completely differently once you flip to taking money out of it every fortnight instead, because now the timing of a downturn matters just as much as the size of it. This is where the idea of a bucket strategy comes in, instead of chasing the lowest fee printed on the label. You split your balance so that a few years of living expenses sit somewhere calm and stable, while the rest stays invested for growth further down the track. A common version puts around 3 to 5 years of expenses into cash and short-term options, and leaves the remainder invested for growth, so a bad year in the market never forces a sale at the worst possible time. A higher fee fund that's actively managed to protect the downside can end up mathematically ahead of a cheap index fund, purely because of what happens in the specific years you're actually drawing money out of it, not the years you're simply letting it grow. Picture two people, each with $500,000 right as the market turns rough in the same month. The first is sitting in a plain index fund. The market falls 20%, so the balance drops to $400,000. They withdraw $50,000 to live on that year, leaving $350,000. To simply get back to where they started, that $350,000 now needs to grow by 43%, which can take years longer than anyone plans for. The second person is in a fund charging a 1.5% fee that actively hedges against downturns. The market only falls 10% for them, so the balance drops to $450,000. After the same $50,000 withdrawal, they're left with $400,000, and they only need a 25% gain to get back to even, roughly half the climb the first person is facing. I used to be someone who thought the lowest fee always won, full stop, no exceptions. Then I watched people retire in 2008 and again in 2022, and it changed how I saw the whole equation completely. At 35, you're paying for growth. At 60, you're paying for a floor underneath you. And those are two very different things to be buying. If the market makes you nervous enough to think about downsizing for cash, there's another purchase worth slowing down on first: the cut-price real estate agent. Selling the family home is often the single biggest transaction of anyone's retirement, and most people judge the agent purely on the commission percentage, without ever running the numbers on what actually lands in their pocket at the end of the process. It's an easy mistake to make, because commission is the one number every agent leads with in that first conversation. Say the home is worth $1 million, which isn't unusual in plenty of capital city suburbs right now. A standard agent charges around 2% or $20,000. A discount agent might charge 1%, saving $10,000 up front, and on paper, that looks like the obviously smarter choice. Most people stop the comparison right there, because a percentage on a contract feels like the whole story. Here's where it falls apart. The agent working for less usually has no budget for professional styling, no budget for premium exposure on the major listing sites, and less incentive to run a proper negotiation once an offer actually comes in. That house sits on the market for 40 days longer than it should and eventually sells for $950,000. After the 1% fee, the seller nets $940,500. The full price agent runs a proper campaign instead, professional photos, a genuine auction process, real competitive tension between buyers who actually want the property. The house sells for $1,020,000. After the 2% fee, the seller nets close to $999,600. I've watched this exact scenario play out with people who were completely certain they'd saved money by going cheap, only to realize months later they'd left almost $60,000 on the table, more than the commission difference could ever explain. The number that matters was never the percentage written on the contract. It's the total that actually clears into your account once everything is paid. And that total depends far more on how well the property was presented and negotiated than on what the agent charged to do it. Speaking of the family home, if selling it makes you think a tax-friendly new car might be the answer, that's worth a very close look too. A lot of 55-year-olds get told by their accountant to buy a dual Cabot worth close to $80,000 before the end of the financial year, purely to write it off against tax. The advice itself isn't wrong on its own terms. The trade-off nobody mentions sits right underneath it. You might genuinely save something like $20,000 in tax, which sounds like a straightforward win when an accountant says it out loud in a meeting. To get there, though, you've spent $80,000 of actual cash or taken out a loan at 9% interest on an asset that starts losing value the moment you drive it off the lot and keeps losing value every year after that, regardless of what the tax office lets you claim. 10 years from now, the tax saving is a distant memory, but the loan or the missing $80,000 is still very much part of your situation. Think about where that leaves two different people at retirement. One walks in with an $80,000 loan and a car payment close to $1,200 a month, still years from being paid off. The full single-age pension currently runs close to $2,600 a month, so that repayment alone is eating up nearly half of it before power bills, groceries, or anything else even enters the picture. The other person kept driving their older car for a few more years, and that same $80,000 went into their super instead. Under the concessional contributions cap for the 2026 to 2027 financial year, now $32,500 a year, that money could have gone in as salary sacrifice and come out later as a tax-free income stream, instead of going out the door every month as a repayment on something that's already worth less than they paid for it. I've seen it most Sundays at the local hardware store car park, brand new utes owned by blokes my own age who are quietly stressed about their super balance the moment the conversation turns serious. It's become a status symbol that costs people their freedom rather than buying any of it back. And most of them would rather talk about anything else at all, including the weather, than admit it out loud. We've covered the big ticket items. There's one smaller daily habit left that's quietly costing you a trip to Europe every few years. This one is smaller than the others, and that's exactly why it slides under the radar for years and years instead of ever getting noticed and properly fixed. Most of us shop at the same big supermarket chain we've used for 30 years because it's familiar and because we tell ourselves the cheaper option down the road has worse produce or a worse range. Honestly, wanting nice fruit and vegetables after a working life is completely fair. You shouldn't feel like retirement suddenly means eating worse than you used to, just to prove a point about saving money. The middle ground most people miss is a hybrid approach rather than an all-or-nothing switch. Buy the cleaning products, the canned goods, and the dry pantry staples somewhere discount, where the saving on those items is close to 30%, and spend that saved money at a proper local greengrocer for the fresh produce that actually matters to how your meals taste. Ask yourself honestly which items in your trolley you'd actually notice if the brand changed, and which ones you'd genuinely miss. Most weeks, it's a shorter list than people expect, usually just the fruit, the meat, and maybe the bread. Everything else in that trolley is doing the exact same job, regardless of which shelf it came off, whether it's dishwashing liquid, toilet paper, or tinned tomatoes for a Sunday pasta sauce. $50 a week saved this way adds up to $2,600 a year, without you giving up a single thing you actually care about at the checkout. Stretch that across 10 years of retirement, and you're looking at $26,000, roughly the cost of a decent car or several genuinely nice overseas trips, just from shifting where the boring items get bought. So how do you close leaks like these across your whole household budget without feeling like retirement suddenly means living smaller? None of these 5 things need a dramatic overhaul of how you live. They mostly need 20 minutes and a willingness to actually look, section by section, rather than trusting that everything set up years ago still fits. Start with your super account first. Find the insurance section, and if you're paying more than $200 a month, call your fund directly and ask them to walk you through exactly what that cover pays out, and to whom, in plain language rather than a product disclosure statement full of definitions. Next, check how your balance is actually invested. If you're sitting in a high-growth option and you're planning to retire within a couple of years, that mismatch is worth a proper conversation with a financial advisor about a bucket-style approach, instead of staying fully exposed to whatever the market does next. Then look honestly at where a small weekly saving, even something like $50, would actually land you against the age, pension assets, and income tests, and whether shifting that money changes what you qualify for once you do retire. Most people only do this kind of audit after they've already retired, when most of the flexibility is already gone and the decisions are harder to unwind. Doing it at 58 instead of 68 is often the entire difference between a retirement that feels tight every single fortnight and one that actually feels comfortable for years on end without a second thought. So that's the list. Stop paying for insurance you've outgrown. Stop chasing the cheapest fee without a floor underneath you. Stop hiring the cut price agent for the biggest sale of your life. Stop financing a depreciating asset to save on tax. Stop paying full price out of habit at the checkout. Retirement was never really about who has the most money sitting in an account. It's about who has the most choices left. If this helped you spot a leak in your own boat, stick around and subscribe to Aussie Retirement with Bob. We're building an audience of people who want to play this stretch of life smarter, not harder. You've already done the hard work of earning it. Now let's do the smart work of keeping it.